This is MarcoVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MarcoVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, 𝘾𝙧𝙠𝙞𝙣𝙑 and Patrick Ceresna.
Now, joining us again in the postgame segment is 𝘾𝙧𝙠𝙞𝙣. Now, let's get to that chart deck. Listeners, you're going to find the download link for the postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at MarcoVoices.com. Just go to the homepage, MarcoVoices.com, and click on the red button over Yaron's picture that says, looking for the downloads. Now, Eric, let's cover crude oil.
EIA inventory is delayed by the holiday this week, so we don't have it, although there was a surprise build reported by API on Wednesday afternoon. I don't really have much to add this week. So far, oil prices are mostly holding steady, and Wednesday night looks like they're trying to push higher. We'll see if that lasts. But tensions in the Red Sea definitely continue to escalate. So there's always the possibility of a major upside move if something really goes badly wrong. Our friend Dr. Anas Al-Haji did an outstanding Twitter Spaces all about the situation with the Houthis in Yemen and how it could escalate and what it means and how it's going to affect shipping and so on and so forth. You'll find a link to that recording in your Research Roundup email. I continue to believe that most market participants are underestimating how long this Houthi conflict will last or how much shipping is going to be disrupted. But so far, the market effects have been minimal. There's definitely a risk of a major escalation sending oil prices to the moon, but we can assume that the Biden administration is going to do all that it can in an election year in order to prevent that from happening. I'm still holding some of my out-of-the-money calls, though, just in case.
Well, Eric, I have a bit of an opinion here on crude because I feel that we've really entered a new phase. We've basically spent several months in a very definitive downtrend. And what we now see is the pattern over the last 2-3 weeks of accumulation on dips, which is we have these $2, $3, $4 drops in crude, and it's almost immediately met with buying that takes it right back into the trade range. And so we really have seen this transition from a distribution cycle with price discovery heading to lower lows to now a trade range, which is very similar to what we saw in the summer of last year. And so really at this stage, what I'm thinking here is that as this base is, we're going to be looking to see whether or not there's a bullish reversal here. Now, before we get too excited about that, it's a reminder that oil spent 2 months trading in a sideways range before the bull breakout happened last summer. And so just because we're consolidating doesn't mean it's imminent. But I put on here that 50-day moving average, including the horizontal triangle pattern. And it's a pretty straightforward technical breakout if we get above those levels. So that's certainly what I'm watching here. Now, let's move on to equities. Nick, I want to get you involved in this conversation. Obviously, it's an OPEX week. We have the big January roll-off, which many individual stock names have a lot of leap options open into it. So there's been a bit of gamma pinning. What's your take and what levels are you watching here?
Yeah, Patrick. So the spot price right now on SPX is approximately 47.40. We have a call wall above at 4,800 and a put wall below at 4,700. The expected move for tomorrow's OPEX, which is one of the largest OPEXs we've seen in the last couple of years, is plus minus 40 points. Therefore, the upper implied move is 47.80 and the lower implied move is 4,700 right at that support area and put wall as well. I'm inclined to think we see a larger move perhaps after the OPEX tomorrow into the February OPEX as gamma unpins and we can see perhaps a lot of volatility pick up, possibly going as low as 46.50. But I do think we still see that all-time high hit on SPX prior to that.
It's interesting. Obviously, we're seeing a lot of toppiness in this market, but it seems too easy of a layup to just go short here. Often the market makes this challenging, and it would not shock me for us to have just one quick break higher that breaks to a higher high, just guns a bunch of stop losses on short sellers that are sitting right above the previous highs. I generally don't think that there's a big upside to this market. Maybe, a quick 100-point rip on the upside. downside. But generally, it is going to be a part of a bigger topping formation. And I think that by the time we get into February, we could already be mean reverting this 700-point rip that we saw in the prior 2 months. And so at this stage, I don't see a lot of asymmetry in pressing the long trade beyond a quick swing trade. And I would start to be reducing position sizing in general or hedging things up along these upper levels. And so, Nick, like on page 5, I put on the breadth indicator, something we touch on here about once a month. We put it in the chart deck. And this is just looking at the percentage of stocks above their 50-day moving averages, just to kind of get a sense of the breadth within the market. We were, at the end of last year, trading at an 87 level, 87% of stocks above, which is actually the highest reading we saw in 3 years, just to kind of give an idea of how broad this market rally was and how overbought the conditions were. And while the markets are a stone throw away still from their highs, this is now massively dropped. We see this back down to the 60% handle on the downside as the breadth of the market is actually deteriorating under the hood. It first started with small cap stocks having that drop and then not recovering. And now we're seeing the equal weight S&P 500 make a bit of a break. So you're starting to see much broader distribution happening under the hood. And that recent run up that we talked about last week on the NASDAQ, driven by some of these Mag 7 stocks, really seems to be keeping the index up at the upper levels. And so it'll be interesting to see whether the breadth continues to deteriorate. Nonetheless, let's actually have a quick peek at that NASDAQ. What levels are you watching on the Qs here?
Spot price right now on Qs is 407. We have a call wall above at 410 and a put wall below at 400. And the implied move for the January 19th OPEX, which is tomorrow, is plus minus 4 points. Therefore, the upper implied move is 411 and the lower implied move is 403. We have key resistance above at all-time highs and key support below at 400. Now, as you said before, Patrick, the breadth has kind of narrowed and we're seeing the Mag 7 drag the market higher, which makes me a bit nervous. I do think that post-OPEX tomorrow, we see a decline in broad markets, likely because we see these Mag 7 weaken. We've seen, for example, NVIDIA pump over the last couple of weeks by over 10%. That's a massive, massive movement in a company already worth well over $1 trillion. I'm not saying these companies aren't doing remarkable things, but I think the valuations are running away a fair bit. Additionally, today there was an upgrade on Apple, and the stock is up currently $4 or so. These divergent views where we're seeing analysts downgrade a stock like Apple a couple of weeks ago and then upgrade it today, for example, tell me that there's a lot of indecision in the markets as to the true value of a given company right now. And these large 7 names, we have Meta, Google, Microsoft, Amazon, Apple, NVIDIA, and Tesla. These 7 names are carrying the markets higher. If any of them weaken, and we're seeing Tesla already weaken a fair bit, we should see the markets fall a fair bit lower.
Yeah, those are interesting observations. Like what is also interesting is the fact that the volatility index finally spiked. I mean, we were stuck down on the 12 handle for weeks and things were really calm. And suddenly, with just a little bit of selling, we've got a volatility heading up toward the 15 level. What's your take on the VIX here? And do you think this is a trend reversal?
So right now with the VIX at nearly 15, we should see on average top to bottom movements intraday of about 1%, which we saw yesterday and the day prior. We're seeing a lot more gapping up and gapping down in SPX right now. And that's telling me that volatility is picking up as we approach this big OPEX, which is tomorrow. Again, I think that into the February OPEX with earnings coming out and FOMC, we should see a lot more volatility, and that should bode for a lower market probably. Right now, I'm not looking at selling premium yet, but premiums are getting kind of juicy intraday. So these zero DTs out of the money spreads are looking pretty nice for me right now. Now on page 8, we have the US dollar index, which has actually made a nice bounce off the bottom right there. What are you guys thinking here?
When Jay Powell pivoted dovishly back on December 13th, the first thing I said was that the market will overshoot on discounting dovish expectations, and that's exactly what's happened. But even in the face of Fed Governor Waller jawboning the market expectations to moderate that dovish enthusiasm, I wasn't expecting a full retrace of the post-pivot sell-off in the dollar, which has occurred since December 13th. But that's what's happened. It would make sense if the stock market were crashing, but it isn't. So while I was definitely expecting the dollar's precipitous fall to retrace substantially, I didn't think it was going to be anything close to a full retrace, and I'll be watching it closely to see if that dollar rally continues.
Eric, you nailed it. It was, to me, the biggest part of this is the fact that we've now fully reversed the Powell pivot, which is where that drop meaningfully broke down. What will be really interesting for me is going to be whether that trend continues, as we have up to bat a number of major central bank policy statements coming out next week. And if they come out relatively on the dovish side, maybe the dollar strengthens under that environment and begins to strengthen. That would be, to me, technically significant because that's the typical price action that you would see on an intramarket basis when assets are transitioning into a risk-off cycle. And so whether that dollar continues this trend higher into next week is certainly on the high end of my watch list.
Now on page 9, we have the gold futures chart, which is declined off the highs right here. What are your thoughts?
The big sell-off this week was a direct result of Fed Governor Waller and other central bankers walking back rate cut expectations. We took out the 55-day moving average as a result of that selling, and the next obvious targets lower if this sell-off continues would be the December 12th low before the pivot announcement at 1988, and then the 100-day moving average at 1981. Patrick, your webinar about how to use collared call options to play the coming bull market that we both expect in gold by the end of the year was extremely well received, and this week's tape action gave you an opportunity to get even better location on that trade. This has become so timely that you're already planning a second webinar for people who missed the first one, so please tell our listeners about that.
Yeah, we had a great turnout on Monday for the special webinar, but we've had a number of people reach out to us that missed it and wanted to see the recordings. Well, we are doing it a second time this coming Monday on January 22nd at 1 p.m. Eastern Standard Time. So those of you that missed it and would like to watch that special webinar, you can register just at bigpicturetrading.com as well. The link is in the Research Roundup email. Now, just touching on the gold chart here, Eric, what is interesting is that this is the first time in about 3 months that we've had a breakdown below the 50-day moving average. But we haven't yet done some significant technical damage. To me, there's significant support here at the round number of 2,000. And the fib zones that I'm watching also lie in the 1950 to 2,000 zone. And so you have a little bit of support coming in here. But if we do go through a risk-off cycle in the broader intermarkets, then it's an environment from which gold could have a deeper retracement. To me, all pullbacks on gold are buy on dip opportunities, and this is just a part of the typical cycles and swings higher and lower. Generally, there is going to be a very strong move in gold later this year, and the question really is that where are the key turn points where the big buying opportunities emerge?
Now on page 10, we have the uranium chart, which we don't cover every week. However, it's had a pretty remarkable run the last couple of weeks. What are you guys thinking here?
The breakout in spot uranium prices above $100 a barrel, I think, was a very important psychological signal. That caused a huge gap up in most of the uranium mining stocks. And of course, technical analysis lore says that most gaps get filled. I already have my resting limit orders set up to buy those gap fills of my favorite uranium insider stocks. And I think this market is just getting started. Of course, we could easily get a big correction in the face of broader market weakness, especially if we get that hard landing and recession that everyone's been predicting for 3 years now. But if that happens, I'll still view it as a blessing and an opportunity to buy more exposure to uranium. Of course, the real story is going to be advanced nuclear technologies. But for now, the only actionable trading strategy that works in public markets is to buy uranium and uranium mining shares. And I think that trade is about to get much more popular than it already is, as more and more retail investors figure out that the only way to get involved in this nuclear renaissance, at least for now, is in uranium and the mining stocks.
Yeah, Eric, what a breakout. Like a 12% move in 1 week. To me, this happens at a stage where typically, if it was just a normal market cycle, it would have already engaged some profit taking. So these characteristics are very much in the nature of bubbles. And so the big thing for me to watch here on uranium is, have we seen this transition into a bubble phase? And will we see some further parabolic rises in uranium here that may have this ripping to 120, 130, or even more on the upside? It's certainly a very exciting move, and it's going to be certainly something that I think will have even further follow through here in the weeks to come. Moving on, I want to cover a few more charts. I wanted to start with the natural gas futures. This is the continuous chart. And what we had was a significant breakdown in natural gas prices in the fourth quarter of last year that just saw an extraordinary drop. And just in the recent 3-4 weeks, we saw a rip to the upside that was quite significant. Just truly is earning its nickname of the Widowmaker with this type of volatility. To me, with this pullback that we saw just this week on natural gas, it's going to be really interesting to see whether the buy on dip traders show up here, because it may be a bottom that we've already seen in nat gas, and the only way to really solidify that is once we retest some sort of key levels to establish a bottoming or basing formation. So it'll be really interesting to see whether this is the turn point in natural gas. Finally, I wanted to wrap things up on page 12 with the 2-10s US Treasury yield curve. And what's interesting is that obviously we were in deep reversion in the summer of last year, and the trend was pronounced down. We were over 100 basis points in the negative, and then we had a steepening, but it was a bear steepening. That 10-year yield just kept ripping as the 10-year bond kept declining, and so we had actually a steepening in what was not the traditional bull steepening that a lot of people were expecting. But what's interesting is since January, in this month of January, since the start of the year, it's actually continued to flatten towards the zero line. But this time, the steepening has actually switched to a bull steepener as the 2-year is actually starting to move. And it's going to be really interesting to see whether or not we can break out of the 2022 trade range and really see this steepen above the zero line, and what the macro implications of that would be.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MarcoVoices is presented for informational and entertainment purposes only. The information presented on MarcoVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MarcoVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MarcoVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MarcoVoices. MarcoVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MarcoVoices.com.